hooray, we have actual news, and it's real news too. We got today the report of employment activity in the month of April. It had been a big debate. There's always a big debate about the state of the economy, and the March payroll report had been lousy. It was less than 100,000 jobs and actually revised down. But we get two payroll reports every month. One that gets all the ink is a survey called the Establishment Survey, which is call up big employers and ask them how many they've hired. The second survey is called the Household Survey, and that's hammer on the door, anybody here have a job? Anybody looking for a job, anybody having a hard time finding a job, and it turns out, based on today's report, that the March figure was just a flyer, didn't amount to a thing. April, 211,000 new jobs, better than anybody had suspected. Companion reports during the week, first week of every month. There's an ancient survey that goes back to 1970. There used to be a National Association of Purchasing Management, which surveyed its members in the last week of each month, asking them, how's business? And these surveys were very predictive. The purchasing managers, in the old days, no computers, they had their hands in the boxes to see how much stuff they had and how they were doing relative to forecast. And they were as good an early warning system as we had. That group has changed its name to the Institute for Supply Management, which nobody understands. ISM. We now get two of them. We get one on the first business day each month, which is based on manufacturing. And we get another one on the second, third, fourth day of the month that's based on the service economy. And those two surveys are doing just fine. 50 is break even. Both of these are in the high 50s, which is as high as we see them. And so the bottom line in all of that is the economy's fine. The characters who have been saying the economy's terrible and we're going to have a recession and it's slowing down, no, wrong. The missing piece is still inflation. There isn't any. That is, we are still struggling to get to the 2% inflation mark, and we're below it. So there isn't any terrible urgency, despite good economic numbers, for the Fed to raise its interest rate. But on the other hand, the Fed has said steadfastly that what it's up to is removing excessive accommodation. It's still calibrated with stimulus for the economy in an emergency situation, and we don't have an emergency anymore. So the Fed's quarter-point rate hikes are just withdrawing an extra boost that we don't need. The Fed sits at 1%. Inflation rate is about 1.8, maybe 1.7. If the cost of money is below the inflation rate, the Fed's still on the gas. The Fed's going to come off the gas. My opinion is tilted to the strong side, and I may be mistaken about that, but my hunch is that the Fed gives us another quarter at its meeting early in June, and then gets ready for another one in fall, and it might begin to slow down or pause once it's at the 1.5 mark and begins to unload the bonds and mortgage-backed securities that it bought. But the next two rate hikes, I think, are in train, and they are not in mortgage rates. Long-term lending has not adjusted to the probability that the Fed keeps coming. So we could get a surprise here as the market gets used to the idea that the Fed really is coming. Near this video is a link to my weekly, and in it is a numbing discussion of productivity, which might help you. Very best of all, good weekend.